Hi, I'm Melissa Withers, Managing Partner of RevUp Capital, and today I'm going to answer a few questions about what we do, why we do it, and who we do it for. Up first, why did we make the switch from equity investing to revenue investing back in 2015? This is really important to why we created RevUp and how we see the world as investors. My partner, Alan Tier, and I, prior to RevUp, we managed an early stage equity fund, and together we had the great pleasure to invest in over 90 companies through that model. But at the conclusion of that period, I found myself very frustrated professionally and personally by the constraints of the equity-only model. Primary among that is the reliance on exits as the only way to win, when I knew from experience that there were many things that happened to a company between the day it was born and the day it might have an exit that were really important and really valuable. And it struck me as really narrow-minded to think that the only way we could invest in and make a return on an early stage company was through its ultimate exit. And another frustration around this model was, as investors in the equity system, my primary responsibility once I invested in you was to make sure you almost immediately raised more money. It's that march towards additional capital which signals to the market that you are in fact heading towards an exit. And what that meant over time was I was spending less time helping founders build their companies and more time chasing dollars, whether they needed them or not. And so at the conclusion of that, we were pretty sure we didn't want to do that again, but we knew we didn't want to walk away from startups forever. So after doing a little bit of soul searching, getting some good advice from others who have come before and had used different models to invest in companies, in 2015, we were able to work with our third partner, Bill, and go to market with RevUp, which uses a revenue model instead of an equity model to invest in a way that I often describe as exit agnostic. So I am not anti-equity in any way at all, but for me as an investor, the switch to revenue-based investing back in 2015 allowed me to focus on helping founders build their companies and leaving a little bit more open about how that might turn out over a 5 to 10 year period. So what kind of companies do we invest in? We are able to use our model because of its flexibility to invest in a pretty broad spectrum of B2B and B2C companies. When companies come into our portfolio, they're in the market and they're selling, but they're really still at the beginning of their journey to whatever it is that they want to be as they go deeper into the market. Most companies come into our portfolio with between about $500,000 and $3 million in revenue, and with plans to become a $10 to $15 million company in the next couple of years. That curve is really important to my partner and I. We've spent a lot of time on different parts of that curve. But about 4% of all companies get to $1 million in revenue, and only 0.4% ever get to 10 million. And so for us, we take a lot of pride and joy in helping more companies make it up that curve. And as you go up that curve, a lot of great things happen to a company. You become more sustainable, you're harder to kill, there's more capital floating around inside the company, and you also have more optionality when it comes to future fundraising. So for some of our companies, they see themselves as being on an equity-enabled exit path. And for those companies, we're usually between seed and Series A. For others, they're going to bypass that and use other kinds of capital to get to the promised land. And then for some companies, we don't know yet. We don't know if they're in a winner-take-all market and if they're the winner. So what our model allows us to do is be pretty flexible along that journey. So what's your average check size? That's always the first question a founder wants to know, which makes a lot of sense when you're putting together your capital strategy. We typically invest between $300,000 and $500,000, at least in an initial investment, and that's a modest investment. And I think what's important to know is that we are not expecting to fill all of the capital needs inside of a company. We invest into the market-facing side of a company, so really helping companies at that pivotal stage between $1 million and that kind of $15 million mark to really start to build a more robust market-facing engine that's going to help accelerate that journey up the curve. And so as a consequence, we're not the only capital in a company, and we're very rarely the last capital in a company. So we sort of fit in that particular place. And that's why our investment size and structure is as it is. So with a revenue model like ours, how do companies return investment? So we use a revenue royalty contract. And what that means is that rather than take equity, companies return value to our fund through a small percentage of revenue over a fixed period of time. That's usually between 36 and 48 months for the vast majority of our deals. And that percentage ranges anywhere between 4 and 7%. And some of that depends on how much revenue a company comes into the portfolio with, what their projections are for that 2 to 4 year period, and then what are the margins inside that business so that we can create a deal that's going to allow us to achieve our returns while making sure that the deal works for the company. This was a great question that came in via email when we were collecting questions for this content. And this question is, what don't you like about your model? And there are things I don't like about the model. And there were things about being an early stage equity investor that I miss. One of the things that we can't do with our revenue fund is invest too early. We're just not a great fit for pre-revenue companies or companies where the early revenue just hasn't created a pattern yet. When you're revenue investing, you're really investing into a revenue pattern. And so sometimes I meet awesome companies and incredible founders, and I really want to get on the ride with them, but I can't do it through RevUp. So I can either support them as an individual investor or support them in a mentorship or advisory capability. But having cut my teeth on hard tech and having spent a long time in the biological life sciences, I love really speculative, innovative stuff. And for our model, and there are other revenue funders who do things differently and they do play earlier, we can't do that. So sometimes for me, it's just a trade-off that sometimes I just can't do what I used to do in order to be able to do what we do today. This was another good question that came in via email, and the questioner said, I recently saw a term sheet of yours, and it looks a lot different than the term sheet that you shared with me a few years ago. What gives? And that is one of the most exciting things about being on the innovation side of funding for early stage companies. I think as a founder and then as an investor, one of the things that struck me was how not innovative investors have been, while we demanded from you, the founders, just a relentless pace of innovation. Innovate your business model, innovate your product, innovate everything. And meanwhile, over the course of 2 decades, the only innovation that we gave you was a safe note, right? Hardly a transformation of how we were capitalizing your businesses. So when we made the switch to RevUp, one of the things that Alan and I really wanted to retain was the ability to be more dynamic, come up with new ways to invest in companies. And as pioneers in revenue-based funding for early stage companies, we knew that the first model would probably change over time. So if you had seen a term sheet from RevUp back in 2015 and you got one today in 2020-21, you would see really different terms. And that's based both on what we've learned now, having done 30 plus companies over the last few years, ways that we've changed our own internal expectations about how to create the right deal that delivers what we're looking for, while also making sure that we can serve the broadest spectrum of companies. And then especially for us, because of our focus on building capacity on the market-facing side, the way that we've done that with our growth team and our internal investment into each company's marketing and sales capacity, that's changed over time too. Both changed to address different sizes of companies who are at different stages, but also to just keep experimenting with the ways that we can achieve our goals together and not let the investment document be the barrier to innovation. And I don't know what I'll do next, what we'll do after RevUp Capital, but whatever it is, I know that I will never return to a model of investing where I don't have the freedom or flexibility and frankly, the responsibility to be more innovative. If you want to work with entrepreneurs and be part of an entrepreneurial journey, then I think you need to be prepared to innovate alongside with those founders. And it's definitely one of the greatest things about what I get to do here at RevUp Capital.